This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have David Morgan joining us this morning from Washington. Spokane, Washington, or close to. And David is one of the world's foremost experts on silver. He is well recognized as the publisher, amongst other things, of silverinvestor.com and the Morgan Report. Welcome, David.
Gordon, it's great to be with you, and thank you for inviting me.
David, when I said Washington, I had to correct that immediately. I didn't want anybody thinking you were part of the Beltway Bandit group. So for those who don't know your background, David, could you actually help some of our first-time listeners may not be familiar with your background, what you're involved with besides what I mentioned?
Well, I could go on and on. I'll try to be brief. My first degree is in Aeronautical Engineering. My second is in business. My passion has always been in business. And I broke away. I was actually laid off in the aircraft industry very early on and worked in the financial industry briefly for brokers, but basically went on my own and started trading for a living. So I've certainly learned that by the hard knocks, the school of hard knocks. And I started the Silver Investor back in 1999. I was doing some consulting before that. And it's been the passion of mine, again, from a very early age. I was interested in money and finance and was under the Uniform Gift of Minors Act and started trading stocks when I was 16 years old. And you have to be legally 18, but there's a document your parents can sign that says, yeah, my kid can do it, I'll let him do it, kind of thing. So it's something that once I learned about money, which was really my main interest, and I discovered about, fiat money and the role of precious metals, and the fact that the Federal Reserve was a private corporation. I knew all this stuff by the time I was 18. I was definitely a lone wolf. I mean, there weren't many people at that age. And of course, I was 11 when the coinage changed from 90% silver coins to Johnson slug. So this thing is almost in my DNA. And having been through one complete cycle in my early 20s with gold peaking exactly on my birthday, in January 21st, 1980 till now, I think I'm in the right industry, Gordon. Certainly have a lot to learn, and I've got a lot to give. So hopefully I'll be of value for you on this interview.
David, we're here this morning as part of our series on financial repression. And I wonder if you could describe in your own words what financial repression is to you and the kinds of things you're seeing that show that this is in fact occurring.
Well, repression is to hold back or restrain or prevent. And that's what the government has done. I think the most important thing I'll borrow from Chris Martenson, and he's taken it from, and I forget who to quote, but one of the biggest fallacies of the human race is the inability to understand the exponential curve. Now, I'm going to digress a moment, and I'm going to say this with a great deal of authority, I guess, that, my engineering degree, and I really liked working in the aircraft industry for the short time I was there, but it was mixed feelings. I don't want to digress too far. But by knowing the mathematical structures and knowing exponential functions and all this stuff, it really, really has helped my economics because there's almost pure logic. I mean, this idea of, the truth is what we want it to be, that you can throw that out the window. If you, bend a wing so many times, it's got this kind of structure, it's going to break. I mean, these are facts. So because of that background, the inability to understand the exponential function is critical to understanding the financial markets because we are in an exponential expansion of the money supply, really the debt system, and all debt systems have eventually failed, and I don't think this one is any exception. And the way to hold back or restrain or prevent the inevitable is to keep interest rates low. And because of that, the debt servicing that has to be paid by the people, the government doesn't pay it. They borrow money into existence. They don't actually print money. They borrow money into existence. And who's on the hook for it? The banks that make bad loans? No, of course not. We have to have the people backing up that. And of course, the average debt right now in the U.S. on the current account basis is $300,000 per person. The last time I checked, there were I didn't know many people that had an extra $300,000 in their bank account to pay their fair share. Sorry, I'm getting wound up. So the idea is that a hockey stick, as most people are familiar with that curve, cannot be sustained. And the only way is to restrain it, hold it back, and prevent the inevitable. Again, I'm repeating myself for emphasis, is to keep interest rates low. Once interest rates start up, the servicing of that debt becomes much and much more difficult. Not that it can be paid off, it won't be. There will be a reset of some type, and we can discuss what those possibilities are. And I'm the first to admit that there isn't anyone on the planet that knows exactly how it's going to turn out, but we have some pretty good precedents in past history of what to expect.
David, we have $5 billion in bonds trading at negative nominal rates right now, and we have Fed Chairman Yellen talking about increasing rates marginally, though, but nevertheless planning later this year, to increase rates. What's that going to mean to gold and silver in your mind?
Well, I haven't been through one cycle, and I'm glad you asked this question. People fear the idea that if interest rates rise, that it's going to kill the gold market. And a lot of people believe that interest rates are detrimental to the stock market as well. And I'll say that from my experience and what I've studied, that when the real interest rate gets positive, that's when you might be concerned about what could happen in the gold market. Quickly in 1980, in the peak of the gold market, true inflation measured in metrics that were really generally accepted accounting principles back then was about 13%. And nothing really happened in the gold market until Volcker stepped in and pushed up the T-bill rate to about 17.5, the long bond over 20, if I remember correctly. But those are round numbers, and that's correctly, what happened. And because there were real interest rates, you were getting about a 7% true yield, that took the gold market down, among other things, but primarily that's it. So the idea that the Fed's going to up the interest rate and use a quarter point, which is what they'll do, I'm sure they'll raise interest rates. So it's almost a showmanship type of thing at this point. It's like, oh, we're so tough, we're going to raise it a quarter point. No one would come in like Volcker and say, I'm raising interest rates to, let's say, 3%. If they did, the exponential curve I tried to explain earlier would be impossible to pay back. It'd crash immediately, and they know that. But they can show their toughness, if you will, by increasing interest rates a quarter point at a time. But since we have true inflation, 5 to 9%, let's take the low side, let's take 5%. To get a real return, you've got to go to about 6%. And if you're at 6%, you're getting a real return of 1% on your money in real terms, not nominal terms. And that's something, I don't know if we need to define it, but nominal is just what you see in the newspaper. That's the price or the something that's printed. This is the inflation rate published by the authorities. That's just a number. What you really need to know is what is the real inflation rate, what is the real true interest rate, and these type of things. Unless you study the financial markets, and it has to be a bit beyond a cursory level, there is such a thing as, what the real return is. Right now, there are no real returns in the bond markets across the board.
David, the gold-silver ratio has always been a great signal, and it's been falling quite significantly a fair period of time, but maybe as important, diverging significantly from the S&P. What's it telling you?
Well, first of all, with the engineering background, I'll build you a watch, Acording, but if you go back and look at the gold-silver ratio from the beginning of this bull market, what you'll find is it started at 80 to 1, and it's still below that, barely. And then we got as low as about 35 to 1 when silver peaked in April, the last day of April 2011. And now we're back up in the high 70s. What it's telling me is that silver is undervalued relative to gold. But it tells a more important story, and that is something that I've tried to convey several times. And that is, my study, and Professor Jastrom wrote 2 books, actually it was several. The 2 that stand out in the precious metals arena are The Golden Constant and Silver, the Restless Metal. When he wrote The Golden Constant, he found that gold did best in a deflationary environment. We also know that it's not totally objective, because some of the times that he did the study for centuries, he did it based on commodity prices. that gold was money. So it wasn't on a fiat system entirely where you could make this comparison. But generally speaking, if you have a real economy and you have sound money, you get a general deflationary trend, which means that your money is worth more over time. So if you had an honest monetary system and it would function properly, what you would see is that if you were 20 years old and you wanted to retire at age, say, 55, you would know 35 years out that each dollar that you saved would be worth as much and probably more by the time you retired. The reason for that is, one, that it's a constant, that the ounce has a value that roughly maintains that same purchasing power or value in the marketplace. And as people are more productive and they learn how to make their margins lower, in other words, increase their productivity and make improvements, then that dollar actually becomes more valuable with a piece of gold happens. So a deflationary environment is actually something that people fear a great deal, but based on a sound money system, it's something actually that was beneficial to almost everybody. And there wouldn't be a need for a financial planner. You know, a dollar today would be the same value or better 10 years, 20 years, 30 years, 40 years, 50 years out. I mean, when you go back to the gold standard, I mean, what the loaf of bread costs the same for 100 years straight. How does that happen? And that's just an example. Is that everything across the board? No, I'm making a generality here because I want to make a point. But that's point number one. So coming back to the silver-gold ratio. Silver is, according to Jastrom and me and my study, and just not about me, I mean, this is pretty much across the board, anyone who studies the metals. Silver is the best inflation hedge, not the best deflation hedge. Gold is the best deflation hedge. So silver anticipated this huge inflationary environment back when QE2 was announced. Silver had trended up higher. It got into channel formation. It was around the $19 level. And for the premium service that I have, I show what trades I do. And once we broke out above 19, I got on board the silver train in a big way for the 25% maximum that I trade with. And I moved all the way up to 26 and started stalling out. And I decided I better take some money off the table. You've got a $7 move in a leveraged position. You have made some pretty decent money. However, I let the market tell me what to do. Once it broke through 26, QE2 was announced and it broke through 26. So I got back on the bandwagon at 26, rode it all the way up to 48 and got out. Lucky, skilled, whatever. We rode that thing from 19 all the way to 48. Looking with hindsight, I wish I'd done even better. Not as far as the numbers are concerned, I couldn't have done much better than that, but gone the other direction or whatever. But the point being is that silver anticipated a huge inflationary boom by moving from 26 to 48. And what happened? It didn't happen. What took place with all that increase in debt didn't get into the general marketplace. It only re-liquefied the banks. So it re-liquefied the banks. This comes back to your main point and what your main purpose is, Gordon, or the way I see it. I want to speak for you. But it's repression. They forced the money into the system, meaning the banking system, and not out in the public sector where you could see the inflation by the cost of a loaf of bread or gasoline or whatever. And because of that repression, the silver market was vastly disappointed, and you've seen basically a bear market ever since. I believe that silver is a better buy than gold currently. I do still believe that silver will outperform gold, and I do believe that we will have enough inflation that you'll see a lot of people move for a safe haven. Silver does have a safe haven status, similar to gold. There is an 85% correlation. So the idea, well, silver only does this and gold only does that. I looked at the studies. I went page by page through Jastrom's work, and silver is mixed. It does sometimes well in an inflation environment, but not always. Best in an inflation environment, as I said. However, this time we're in a crisis condition on a global basis. And so people that can't afford gold will move to silver. And we've never been in a situation where, one, it's been global. Well, two, you have the internet and the communication facilities that we have now. So the ability for people at large to move in to the precious metals is extremely easy relative to any time in recorded history. And there's less metal per capita than there's ever been because there's 7 billion people on the planet. So the potential to move into the metals is huge. And then we're at perhaps 1% of the monetary assets are covered by the precious metals right now. No one knows the exact number. I just want to make the point that if you went from 1% to 2%, that would double the demand of physical precious metals, double the demand. So just think of what doubling demand, that would mean that only 2% of the financial base is covered by precious metals. So that, I think, is what we're facing. I think that's what's going to take place. I do expect it to start up sometime around September, October of this year. And I think in 2016 will be a very robust year. And some of my contemporaries think that, 2017 will be kind of the blow off. Others think 2020. I mean, no one knows. But I do think the worst is pretty much behind us. We're testing the new lows as we speak, Gordon, and I think gold's got a print of 1131. If it gets below that, then 1080 support. Silver's got a intraday low of 1415. That was in the aftermarket, which I don't count. I mean, it's there. Someone traded a contract at that level, but we're below 15 as we're doing the interviews, so it's probably going to probe, I think, 1450. But, people tell me 9. Look, I've been in the silver market for 40 years, and if there's anything I'll admit, it's that silver can surprise even me. What I do know is it has intrinsic value. In fact, the value of silver, I could argue, is more valuable than gold from the aspect of its usage, for solar panels and biocides and reflectivity and conductivity and all that stuff. It's a very useful metal. So I think I've overdone it, but to sum up, the gold-silver ratio is out of whack. Silver is set to outperform gold. I think if you're overloaded gold, you might consider trading some for silver. I think everyone should own both metals. I think the older you are, the more you should favor gold over silver. It's more stable, it's more recognized, and it's much more establishment than the silver market. But nonetheless, if you're young and aggressive and you can afford the risk, I think you should look harder at the silver market. But again, I think all metals portfolios should have metals. They should have both gold and silver. Ratio of what you own in your portfolio can vary depending on your risk profile and your age.
Even as we talked this morning, we see silver getting hammered on this $1.4 billion of dump in gold futures market. We see the president of the Majestic going against the CFTC on silver manipulation. I know you've written an awful lot on this and what it means with the fractional reserves banking system in your manifesto. Can you help our listeners understand this a little bit better?
Just finished recently the Silver Manifesto, and I don't have time to go through it all, but we go through, kind of the boring topics of fractional reserve banking. And then we go on the topic of fractional reserve bullion banking, because once you understand fractional reserve banking and a debt-based monetary system, it's easy to move over into how the bullion banking system works. And then once you understand that, you can see how it's quite easy to manipulate these financial metals, or these monetary metals, I should say, with financial repression. In other words, to prevent and to hold back and to restrain what they would do in a free market. Because most of the supply that is demanded is satisfied by paper, not by physical metal. If you had a cash-only physical settlement procedure, you would have far higher gold and silver prices. There's no doubt, but that's not what we have. What we have is a vast fractional reserve system where paper satisfies the demand most of the time. Having said that, I want to be very clear that at the margin, which is what moves all markets, and you can look that up on Google if you don't understand what I mean by at the margin, but it's the last bidder of the Rembrandt at the Sotheby's auction that gets the painting. In other words, the last bid, the highest one that gets whatever you're purchasing. Same thing in any market. It's the last bid on a stock that drives it higher that gets to purchase it. So what I'm saying is that the $15 level for silver, the physical demand right now is being met. And I know that because, well, it is and it isn't. I'm going to get a lot of silver bugs mad at me. On the commercial side, you could buy silver for $15 an ounce. And no one buys it at the spot price, by the way. I mean, when you sell it to a dealer, they buy it at the spot price. But when you buy it from somebody, even off exchange, you pay the spot price, plus there's fees and paperwork, et cetera. So you're going to pay more than the $14.99. However, that could be satisfied at some amount. I don't know what the amount is, only the market knows that. But in the retail market, you have these huge discrepancies between what the spot commercial bar price is of $15 and what you would buy a Silver Eagle for, which you can't buy right now. You can buy them, let me rephrase it, you can't buy them direct from the mint right now. They basically held off because there is a shortage. It can't meet demand, so they're not going to start supplying Silver Eagles until August. And you've seen this pretty much across the board in the retail market. This happened again in 2000, or happened previously in 2008, where the demand for silver was very strong at a low. So silver investors are pretty smart. When they see a buying opportunity, they take action, and I commend them all for that. But you had $9 silver, sub $9 silver, and you saw Silver Eagles on eBay for like $13.50, silver rounds for like 12.5. You saw small bars, like 10-ounce bars, even 100-ounce bars, with like a 30% premium. Gold enjoyed that as well, but not as high a premium as silver had. There was a big rush. It lasted for a few weeks, and then the arbitrage opportunity was huge. I myself bought 3,000 ounces commercial bars, 3 commercial bars, off of the exchange, and had it shipped to a minting friend of mine and minted them into 1/2 ounce rounds. And I didn't sell them. I wasn't, wanting really to scalp anybody. I just thought I wanted to buy low, and I wanted in a form that's the best, which is, small units, not big bars. They're, for industry basically. So probably over-talked that, Gordon, but I really, really believe that we're not out of the woods. There is a place for precious metals. I'm ready to say 20% is probably best for metals bugs and 10% for the average public. You don't have to put all of your money into the precious metals. There are opportunities. People are inventive. There are bright spots in the economy here and there. But overall, this financial repression is basically a big, like a coffee press, pressing everything down. I mean, they basically have suppressed the ability for us to have a free market, enjoy the fruits of our intellect, our labor, our creativity, and our purpose as humans. I mean, really, the repression gets even spiritual. I won't go there, Gordon, and bore the audience, but the repression goes basically into your soul almost. I mean, money is extremely important because it transcends everything. No matter what religion or what your sexual orientation or what your political beliefs, everybody wants to know what the heck their money's worth.
I've just completed a number of videos on Greece, the most recent with Charles Hugh Smith, where we are looking at the kinds of controls that are being used to force certain political behavior, getting your cash out of the bank, not access to the ATMs or the restrictions on ATMs, to the point where they're almost using ATMs as political weapons to force behavior. Can you comment on that, David, in the context of gold and silver?
Well, you said the preemptive word. I mean, the whole thing, the way I see it, is base as I can be at a very gross level, is that people at the top are control freaks. They want to control everything that we do. They want to control the money, and they want to control, they want to know everything you buy, everything you read, everything you watch, what your political leanings are, and on it goes. And they, in a free market, you have freedom. And this is anything but freedom. And so the idea is that they know what's going on. So it's back to the repression. If you're going to prevent or hold back or ring around, well, the last thing you want people to do is to do a bank run, which means as much as fiat money is fiat money, the safest place to be in that system is really, it's a gold and silver. But if you couldn't get gold and silver, assuming it's fiat only, the best place to be is physical greenbacks or physical euros or physical pieces of paper. Why? Because they can be held outside the banking system. And the bankers know that. So the way to prevent a bank run is to say you can't have cash. So now these control freaks are controlling that one exit that most people have available to them. So in the Eurozone right now with Greece, you get 60 euros a day, is it, or a week? I'm not sure. I guess it's a day. Same thing happened in Argentina in the 2000 crisis when they had a currency crisis. You could only get, and I don't know what the number was, but so many pesos per week. So they didn't take your bank account, but they prevented you and held back and restrained what you could pull out of your bank account. The other part, of course, is bail-ins, which is in legislation now. Most people in the United States are unaware of that, which basically means, if you want to start, you just basically take everybody's cash out of their bank account and start over. So you have no savings at all. It's not being depreciated by inflation or debased by currency printing or by QE infinity. It's basically taken away, period. And they have the right to do that. When you sign a signature card, people think, oh, it's my signature, I better make it look good, and they're going to compare my signature against, when I sign my check. No, read the fine print, read what it says. It says this asset is ours now, we're holding on to it. But and if you want it back, chances are you'll get it back, but in the fine print it says not necessarily so. Big boy, buck up. It's in our bank. So it's really, it's very sick in my view, Gordon. I've looked again at this stuff for so long, and I'm certainly not tired of it. I'm still passionate, but what infuriates me is that there's so much belief and sort of a malaise in the general populace about money and banking. And it's very important, as I said earlier, it transcends almost everything, but people don't get that wake-up call until it's too late. It's like, oh, I wish I would have known something. But shows like yours are getting people educated. I think with the internet, there's a lot more people that are awake and aware. The problem is action. Satisfaction comes from the root word of action. If you don't take action, you really can't have satisfaction. And I'm not taking a reference to Mick Jagger, excuse my pun. The idea being that people that actually get cash out or take a check or their credit card down to their local coin dealer and buy gold have made a commitment. And that commitment is at some level that, I don't trust the fiat monetary system or the banking system totally, and I'm taking this action with my hard-earned cash to buy something outside of the financial matrix. The only things that don't have a counterparty risk that are monetary assets. And I believe, I'm with you, Gordon, I want to digress a bit. That I'm tired of this. Gold is the only financial asset that's not, simultaneously a liability. Look, you could have a pile of plywood, you could have 2x4s, you could have copper, you could have a garden. There's lots of assets that you could own that are not a liability at the same time that are valuable in the marketplace. It's not just gold. In fact, that's right. So, this idea it's only gold. No, that's a gold bug attitude, and I'm somewhat a gold bug, obviously more of a silver bug. But the point being, look, you can have a lot of assets that are going to be very valuable when the reset happens, and it doesn't have to be precious metals. In fact, I'd encourage the audience to think outside the box. Say, look, if things went down, what would be of value to me and my neighbor? If you could fulfill that need, and you can hold it now, be it food, be it a skill set, be it whatever. That's something of value that you should pursue, especially if you're passionate about it, and be ready at the fore, or maybe do it now, get into the market already and be prepared, because when this happens, and it is happening, it's not like it's an overnight event. A soup line doesn't start with, the entire city standing in line because they can't get a job. It starts with 3 guys, and then next week it's 12, and the week after that it goes half a block, and then 2 months later it's 2 blocks long, and that's how it happens. And that's what's happening now. You look at what the food stamp situation is. We're at 44 million Americans that are on these EBT cards. It didn't start at that number. It's got to that number.
It just isn't the food stamps, which are horrendous. It's also local communities with cupboards of kindness, food kitchens, etc. The lineups there are significant if you're ever around to see them. And at the end of the month at Walmart, you can see the impact of food stamp cards. Could you share with our listeners any final comments you'd like to make?
Yeah, I think it's to be a lifelong learner. I think, one of my passions is continue to learn. Life is fascinating to me. There's so many mysteries about it. Money is one of my passions, obviously, but I think balance, I strive for balance physically, I want to stay, healthy. I think so much corruption. It's corruption in the political system, the monetary system, the air supply, the water supply, the food supply. So get real, buy real, and be real. Be true to yourself. I think those words from the Oracle of Delphi are important, especially in today's world. And you know what? No one is the boss of you. Act free. Be free. because that's how we're going to beat this thing. You're going to have to stand up, and at some point, people are going to be tested. And I don't know how, because it's going to vary across the planet. It's going to vary community to community, but be of value to yourself, and therefore you can be of value to others. That's how I like to sum it up.
David, could you tell our listeners how they could learn more about your work, your involvements, and your website?
Sure. The best thing to do is get to our main website, which is silver-investor.com. All that stuff's available. Only go to thesilvermanifesto.com, and if you just want free information, the YouTube channel is Silver Guru, and the Twitter is @SilverGuru22.
Dave, it's been a real pleasure having you, and we've got to have you back later on in the years. Thanks for joining us this morning.
My pleasure, Gordon. Thanks for having me.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.